Non-business income refer to earning outside core business activities and include various sources like investment, rental properties, royalty, and personal activity. It encompasses interest, dividend, capital gains, rental payment, royalty, and other non-commercial streams. Real estate, intellectual property, gambling, winning, gift, inheritance, alimony, and child support contribute to non-business income. This diverse income required understanding for effective financial planning, covering employment, investment, rental, and pension income. Awareness of non-business earning is crucial for informed investing, tax consideration, and overall financial well-being. Employment income includes salary, wages, bonus, and commission earned by individuals for their service as employee. It reflects the value of labor and contribution to work. Tax break, deduction, and child benefits impact net pay. A solid understanding of employment income is crucial for financial stability, guiding financial planning, budgeting, and investing decisions. In employment income, there is 5 types of employment income, which are under Section 13(1)(a) monetary benefit, Section 13(1)(b) benefit in kind, 13(1)(c) value of unfurnished accommodation, 13(1)(d) refunds from unemployed fund, and the last one is 13(1)(e) compensation for loss of employment. In the section of 13(1)(a), employment income include wages, bonus, gratuity and allowance, remuneration, and perquisite. Wages are regular bonus fixed, and gratuity given at retirement. Allowance like housing or meal allowance increase the total income. Remuneration cover all compensation, while perquisite are non-monetary benefits. Tax implication vary with the exemption based on retirement age and service year. Understanding this component is vital for financial optimization. The next one is under Section 13(1)(b). Non-monetizable benefits like medical or dental facilities and certain holiday fares are excluded from gross revenue. Motor car benefits providing a company vehicle for personal and business use are calculated based on the car's value and fuel. If the car is over 5 years old, the benefit is half the rate. If only gasoline is provided, the benefit is the actual expense, limited to employee and immediate family only. The next one is Section 13(1)(c). In employment income, living accommodation benefits involve providing housing to employees. Divided into 3 categories. First, the value is defined or 30% of the gross income. Second, for director in control company, the value may change if shared. Third, for employees in hotel or similar, it 3% of gross income. For the Section 31(d), in employment income, refund from unemployed fund include employer contribution to pension or savings scheme and interest. The taxable portion included employer contribution and benefits from total contribution. The employee share is exempted. The last one is Section 13(1)(e). In employment income, compensation for loss of employment include payment for notice, breach of contract, and severance. Exclusion apply for illness-related work stoppage or a maximum of 6,000 per year of service.
So we will move to the rental income. What is rental income? Rental income is a source of income under Section 4D of the Income Tax Act 1967. Rental income is the money that a person or organization receives from leasing or renting out real estate that they possess to a third party. It is include vacant land, apartment complex, terrace house, business establishment, and others. So next we will move to the calculating the rental income tax rate. For the tax resident, the rental income tax is typically levied at a rate between 0% to 30%. Meanwhile, for non-resident, the tax rate is fixed to 30%. As the example of the table given, the amount of the rental will be times by the months of the year. For example, 2,500 times by 12, and we will get 30,000. After that, we will minus the amount of the rental with direct expenses, for example, the assessment, insurance, quiet rent, repair and maintenance, and bank interest. So the amount of the direct expenses is 18,300, and after that we will get 11,700, and that is the statutory income from a rental. Also have deductible expenses, which is the expenses that will not going to be taxed. For the first is repairs and maintenance, interest on loan for purchase of assets, fire or burglary insurance premium, the assessment and quit rent, the cost of advertising, the renewal of tenancy agreement, the cost incurred for pest control, sewage charges, security services, and repainting of the rented premise. So here is the things to consider when filing income for tax rental income in Malaysia. Firstly, we need to determine whether your rental income is residential or commercial. This is because there may differences in the tax law for rental revenue from homes and businesses, and by doing so, it will allow you to pay only the tax that you are liable to pay. Secondly, you need to know the start date, recognize when your rental activity begins. And the debts when a property is rented out in accordance with rent agreement are known as a start debt or a commencement debt. And therefore, knowing the beginning dates of the rental of your house is very important. It might assist you in figuring out how much rental tax is owed. Thirdly, you need to make sure to find deductible expenses and determine and record the deductible costs related to your rental property, such as the air conditioner installation, minor renovation, and agent commission to find a tenant. Lastly is interest on property mortgage. For landlord, interest on mortgage real estate is a sizable deductible expenses, and this can assist reduce the amount of rental income that is taxable. Make sure you keep accurate records of the mortgage interest payment, including lender statement, and when you disclose your spending throughout the income tax filing process, this will be very crucial.
Main capital money earned from investment in various financial instruments or assets. There are three types of income that will be discussed under investment income, which are dividends, interest, and capital gains. A dividend is a distribution of a company earnings to its shareholder, where it can be in cash or stock. Typically, it pays quarterly. Dividends in Malaysia are usually taxed based on individual total income. There is a tax system where companies are taxed on profits, and dividends to shareholders are not taxed again. Other than that, non-residents receiving dividend may be subjected to withholding tax, where it will determine by tax treaties. The company deduct withholding tax before releasing dividends to non-residents. No withholding tax on Malaysian corporate dividends. While unit trust, reserving for resources, income tax at 38%. The exemption for dividend is dividends to cooperative society made first, unit trust, property unit trust, venture capital firms, the voucher company limited, and one-tier dividend system. Income providing constant income stream which can be particularly attractive in time or low volatility or economic uncertainty. Now let's touch upon the taxation of interest income. Generally, interest income is taxed at the investor ordinary income tax rate. However, some type of interest income may be exempt from federal and in some cases state and local taxes. However, it's important to note that exemption do not apply to interest paid or credit to company within the same group. Also, within condition apply to specific financial institution and special purpose vehicle import in the issuance of asset-backed securities. The gains are the profit from selling investment that have increased in value. Investors, especially those in growth investment like stock or real estate, often rely on capital gains as a significant income source. Let's look at capital gains tax (CGT). The amount of CGT varies based on the investor tax rate and holding period. Long-term gains held for more than a year are generally taxed at a lower rate than short-term gains. For example, gains for asset held before January 1st, 2024 are taxed at 10% on net gain and 2% on gross disposal price. However, it changes effective January 1st, 2024 where CGT rates remain at 10%, but now it's not applicable on gross disposal price. The 10th condition allows CGT exemption for shares related to IPOs authorized by Bursa Malaysia. Exemption also applies to restructured shares within the same group and shares from venture capital companies. Next is from gains from asset outside Malaysia. Gains from the disposal of capital asset outside Malaysia repatriate into Malaysia are subject to income tax rate. For example, corporations and LLPs have a 24% tax rate, while cooperatives have scale rates from 0% to 24%.
Pension is crucial financial support system retires and their dependents and come with various benefits, including monthly service pension, lump sum rewards, and even cash reward for holidays. There are also disability pension and dependent pensions. It's important to note that tax treatment varies with the pensions from unapproved funds subject to taxation. Individuals with multiple pensions may qualify for tax exemption on the highest amount. The retirement before the mandatory age affects taxation until reaching the specific age. Exemptions exist for those meeting retirement age or facing ill health, ensuring a secure financial future for retirees and their families. Annuity is a contract in which an insurance provider guarantees a lifelong income in exchange for a one-time lump sum premium payment. It makes sure that the lump sum is turned into lifetime income. Types of annuity is immediate annuity and deferred annuity. There is a tax relief up to 30,000 ringgit Malaysia yearly for those contributions in deferred annuities to enhance retirement income. When a beneficiary receives an annuity, the beneficiary is considered to have received income from the trust and is subjected to Malaysia taxes on that income. Secure retirement with the Employee Provident Funds is in Malaysia designed to help workers save by contributing a percentage of their salary monthly. Employers also contribute fulfilling their commitment to enhance employees' retirement savings. At 55 years old, members can withdraw APF funds as a tax-free retirement income. Contributors enjoy annual income tax relief up to 4,000 ringgit Malaysia provided by LHDNM, supporting long-term financial well-being. Private retirement scheme in Malaysia is a voluntary service entity overseen by the Malaysia Security Commissions. Complementing existing mandate scheme PRS allow flexible withdrawals monthly or lump sum. By saving through PRS, you qualify for up to 3,000 ringgit in annual personal tax relief and credit enhanced retirement savings. Benefits from annual contribution tax reduction provided substantive savings. For example, with yearly income between 50,000 ringgit to 70,000 ringgit and 11% tax rate, a 3,000 ringgit PRS contribution can save you 380 ringgit in taxes.
General discount represent the deduction made from the amount of a bill of exchange or promissory debt, and who will give value for it before it is due and taxable under Section 4C of the Act, and has the profit arising from discount received from discounting transaction. The basis period of assessment is the calendar year and is it said to be derived from Malaysia. If the bill of exchange is transacted in Malaysia and give to profit, the profit from discount are taxed only when is it on the maturity date of the bill and the date of the sale, whichever is the yearly. For the royalty, the Internal Revenue Service (IRS) define a royalty as a something paid to obtain intellectual property or to use intellectual property or right to such property. The example included in royalty is trademark, patent, secret process or scientific work. Royalty also assessed under Section 4D and may fall under Section 4A if it has the quality of a business such as an author. Any person receiving royalty income will be subjected or taxed in Malaysia if the royalty income is derived from Malaysia and received from Malaysia from outside Malaysia. If any person applies to resident, specialized industry like banking or cooperative society. And lastly is annuity. Annuity defined as a sum of money payable on a regular basis in annually or by installment either in property in life. It will be exempted from income tax if the sum received by the way of annuity granted under annuity contract issued by Malaysia Life Insurer or takeover operator.
So here is the comparison and contrast between the sources of non-business income. We compare each of them by the section, by the allowable expenses or deduction, by the tax and others.
Wages in bonus are considered employment income under Section 4B, which necessitates a true computation for compliance. The progressive tax-oriented income, which is defined by Section 4C, necessitates a calculated tax strategy. Dividend and other investment income are subject to Section 4D, which requires strategic action to reduce tax. According to Section 4A, retirement reserves must take into account a number of tax rates. Royalties, discount, and annuities all have the tax implications that should be managed carefully. It is crucial to use a tax reduction approach, which necessitates a deep comprehension for the exemptions. To meet this challenge, in-depth knowledge and additional research are needed with a focus on professional advice and financial success and compliance.